All right, welcome back. The last section, we looked at kind of like looking at the controls and the risks in around the reports that are being used for management to execute manual controls, so IT-dependent manual controls that rely upon reports, and the challenges in around understanding when the logic on a report would be changed, both in a SaaS system and an on-prem system. We're going to switch topics on this one and talk about one of my kind of favorite topics and kind of my pet peeves in the area of auditing ERP systems is the concept of what I call auditing around the system. And that would look like the financial audit team saying, we're not going to rely upon the system. We're going to place no reliance upon the system whatsoever. We're just going to pull a population, and that population, we're going to assume we can pull a population that's complete and accurate, and then we're going to test the controls by sampling that population. And I would argue, I'm going to go through an example here, but I'm going to argue that this concept of auditing around the system, just assuming that the population you're pulling is accurate and complete, is a very flawed approach. In every ERP system, I can say there's a need to understand how the ERP system works. Every process flow, there's a need to understand how the system could be designed, and then how the system is actually designed, in order to say that if the financial auditor is really truly pulling a population, that the population matches the risk and that it is complete and accurate in the approach. So I will make the argument that some level of understanding how the system works is necessary in all cases. And I'm going to just whet your appetite on this one here, because I have a series of teachings on this topic in a variety of areas, like vendor master maintenance, procure to pay, order to cash, or quote to cash. I mean, it costs kind of across all the different areas of critical risk within the system. And I'm going to go through and give you a little bit of a snippet of that on the journal entry side, and would suggest that perhaps that like, if you want to learn more about this topic, you'd want to look at our auditing controls and ERP system series. So there's another class that I have that's auditing journal entry controls that I'll talk about, just a sample of what that looks like, trying to make my case here. So auditing around the system is a flawed approach. So in really understanding, so often, like, I'll start with a definition of a typical journal entry control. The typical journal entry control would say the person that enters a journal entry can't be the same person that would review and approve the journal entry before it's posted. So effectively, there's a separation between the development of the journal entry and the entry of that into the system, and then the review of that journal entry and the approval of that. So the approval could be through the posting process. As often, that's the way that that roles are designed, is you have somebody has the ability to enter a journal entry, and they don't have the ability to approve it. And then another way, the way the approval is documented is somebody has the ability to post a journal entry, and that posting is effectively the authorization or the approval of that journal entry. So if the control doesn't specify how it's being implemented, and the control just says, all manual or non-standard journal entries are subject to review and approval by somebody other than the person that prepared it, the question is how is that implemented? How is that practically done within the system? It could be done by separating via role design. Somebody enters it, somebody approves it, or somebody enters it, somebody posts it, and the posting is the approval process. Or it could be it's a workflow-based process. So it's segregated via configuration. So that would mean a workflow process has been implemented such that when somebody enters that, it gets routed to somebody else, and it can't be routed to themselves. So the workflow design would prohibit somebody from approving their own journal entry. Now, there are systems that would have a flag that says, can the preparer approve their own journal entry? And while that seems counterintuitive, and it seems like, well, why would a system be designed to allow for that? Because from a kind of a Sarbanes-Oxley perspective, if you will, or from a compliance perspective, it doesn't make sense that you'd ever allow somebody to approve a transaction, in this case, a journal entry that they entered. But nonetheless, you're going to find ERP providers that provide that checkbox in the design of the workflow approval process. So if I don't know whether or not that exists, and how it's configured, and is it configured consistently throughout all the entities. And I just pick a population of journal entries, and I maybe don't uncover the fact, because the data I'm pulling doesn't really clearly delineate that they entered and approved their own journal entry. Maybe the report is flawed. Then I may have pulled the population and tested that population, and or maybe my population just didn't pick that 1 in 1,000 scenario where somebody has entered and approved their own journal entry. So those are two examples. Like, how am I implementing the controls? Is it segregated via role design? Is it segregated via configuration? Another example I like to talk about in this area is ability to modify journal entries created from a subledger. So often there's as accounting happens within subledgers. So like the payables module will have invoices coded to those, and maybe an approval process for invoices, or the approval might have come from the purchase order. And there's a coding of those invoices that happens, and ultimately maybe once a day, once a week, or once a month, there's a entry from all the activity in AP that's then sent over to the general ledger, where it's going to debit expenses according to coding, and it's going to credit AP. And then, when the payment's made, it's going to debit AP and credit cash. So subledger journal entries, they can have problems with them. So when the journal entries come into the general ledger, it could be that the coding is wrong, or the coding that was done is no longer accurate, or maybe it's entered in a flawed manner. And then when it hits the general ledger says, nope, that you can't use that chart of account value. And that happens, without going into a lot of detail, that's a common problem that organizations face. Think about another scenario where the journal entry is coming in from another system altogether, like payroll, and trying to keep the payroll system, like the natural accounts and the departments, in sync between the two systems. So you could have something that was created in payroll that isn't in your financial system. It comes in, it's going to say, hey, oh, this value that I'm coding this to doesn't exist. Maybe there's a department reorg, and you're disabling some departments in your financial system that didn't get disabled or at all, or in a timely manner in your payroll system. So that's the challenge of keeping systems in sync. So you may have a journal entry coming over, it gets suspended, and somebody then has to ask the question, this is no longer a valid account. What account does this belong in? So somebody's going to look at that suspended journal entry and say, let's say it's hitting an asset account, and you should be just coding it to another. Maybe a better example is it's an expense account, and you should be coding it to another expense account. So it's a $100,000 expense that's going to hit, and instead of hitting department 1, it's supposed to hit department 2. And so a kind of routine, normal way of maintaining that is fixing the right department. But the chart of account value itself could be overridden as a whole. So it could be have designed to be hit to an expense account, but then somebody could put that to a balance sheet account, or an income statement account that may mess with the flux analysis or other things. So they could use that suspended journal entry process, if you will, to manipulate financial results. If the system allows that and it's not properly controlled, then your journal entries might not be your population of journal entries where somebody's able to manually manipulate the data on the balance sheet and income statement, that you may be overlooking this risk and may not be including that as part of the population over journal entry controls. So I would argue very strongly that there's a basic understanding of the way the systems are implemented, and that's what we're doing in our series, this auditing risks in ERP systems series. As an example, auditing journal entry controls in ERP systems. We're providing examples of how ERP systems can be implemented, and we would make the assertion that the external auditor should be asking, management, do they have the right controls, and the different types of controls based upon the different types of journal entries. And this is just a few examples here. I think I go into about 10 or 12 in the full class. So my assertion is auditing around the system should not be allowed. It's a flawed approach, and some level of understanding of the way the system is designed or can be designed needs to be documented by the auditee, by the external auditor in this case, to make sure that they don't mis-audit the system or let's say audit around the system where they really shouldn't. All right, on to the next topic. We are in the next section going on to cybersecurity risks. We'll see you back in a minute.